This is part 4 of our Chapter 2 video lecture series. This is the last part. We had left off in part 3 preparing the company's general ledger, and then we had calculated the balance here at the end of every account. What we're going to do is take these balances, be they debit, or here liabilities have credit balances. Common stock has credit, dividends has a debit balance, revenues have credit, the normal increasing balance. Expenses have debit balances. All these balances in bold or I'm marking, we're going to take them and put it onto a two-column document called a trial balance. Here are debits in the debit column, debit balances, and credit balances in the right-hand column. And one of the objectives of preparing this trial balance is to make sure the total debits coming from that general ledger equal the total credits in the general ledger. In other words, our general ledger is balancing. That's probably an indication you're on the correct track. As this does not ensure there are no mistakes. There still can be possibly mistakes. And maybe if your numbers down here don't total to the same amount, when we total a column of numbers, we call that footing. If they don't foot to the same amount, then maybe you just added wrong. So maybe you should try adding it backwards to see if you get the same total. Or maybe you put the amount in the wrong column. You just misread, oh, this debit you accidentally put in the credit column. And this total would be off by that amount short, and this would be off over by that amount. Or the error, the difference between these two would be double this amount. Yeah, $8,550. Maybe you misread the amount as 2,000, so you put in an extra zero here. And the difference here between the two totals, if this were 2,000, would be evenly divisible by the number 9. I'm not sure why, but it goes in evenly without any remainder. Or maybe you misread again and you put in 4,100 over here. Again, the difference between these totals would be evenly divisible by the number 9. So that kind of gives you an idea of how to trace mistakes. Now, the mistake could go all the way back to the journal. And here's some steps you may have to take to fix those types of mistakes. But accountants really like working with a trial balance because in a glance you can kind of see the financial condition of the company and its profitability. For example, right now on this date, I should have this amount of cash to spend. Oh, look, customers don't owe me anything right now, so I can't expect any cash flow coming in right away from bills I haven't collected. Or here's the amount of supplies I have. Maybe I need to reduce this for the amount I have used up so far. Insurance I have right now. Equipment I own. Oh, look at this. I have to pay off some bills pretty soon, accounts payable. I have to provide some services that I already got the money here under unearned fees. I paid our stockholders this amount of dividends for December. Here's the reason why we're in business to earn this revenue. And expenses we incur. I paid my employees this amount for the month. Here's the rent I have to pay. Maybe I'm offsetting it because I'm subleasing part of my office and collecting this amount of rent. Here's some utilities I'm paying. Maybe it's going to go up because of inflation and my electricity bill is going to go up. So again, you can kind of analyze the profitability and financial condition just by taking a glance at a company's trial balance. But this is not a formal financial report or financial statement. What we're going to do is transfer all of these amounts into those financial statements we saw back in chapter 1. And of course, there's a certain order we prepare those financial statements. The first one is typically the income statement with revenue and expense accounts, calculating out the company's profit or net income. And then the retained earnings statement, keeping track of how much profits our company are keeping since its inception. And then the statement of financial position or balance sheet, basically rewriting the accounting equation. assets are equal to the liabilities and equity, but in more detail. So here's the income statement for a period of time, in our case, the month of December, and our two revenue accounts. These two columns here is not debit and credit, but just a grouping column here with a subtotal on the left right-hand column. So here's our total revenue. And our three expenses and the subtotal. So these two subtotals over each other makes it easier in our case to subtract one from the other to get our company's net income or net profit. Of course, if we have more expenses than revenue, that difference down here would be labeled net loss. So we're pretty profitable just for 1 month. And now we can kind of plan ahead how to keep up or increase this profitability based upon increasing revenue or maybe even keeping expenses the same or don't let it grow as fast as our revenue. We're going to take this net income and then prepare the next financial statement, again, our net income, and transfer it to the statement of retained earnings. Since this is a new company, we don't have any retained earnings from any previous period. We're paying out $200 of the earnings to the shareholders. We call that dividends. And we're keeping the balance here of $31.95. Again, retained earnings is just like a new account we're learning here in chapter 2. Right now it's still zero, but in next chapter we're going to see how we're going to transfer all of the revenue and all of the expenses and all of the dividends and squish it into our retained earnings account. This retained earnings is going to be the beginning balance for next period's retained earnings statement, adding in the next period's net income, minusing out the next period's dividends to get the retained earnings at the end of that next period. This retained earnings now is going to show up on the company's balance sheet, which is the third financial statement. The last one we will prepare here in chapter 2, a company's balance sheet. And as we learned back in chapter 1, basically this is rewriting that accounting equation. Assets, or here total assets, are equal to, let me write that in, equal to liabilities plus the equity, or here's the total liabilities and equity. And again, it's matching. Yeah, matching. Now, this is not the same as total debits that we saw in the draw balance. This is not the same thing as total credits on that draw balance. Okay. If I go back to the trial balance, you take a look at it and compare the totals of that trial balance with here the total assets and the total liabilities and equity. And you tell me why there's a difference. Let's take a look at the financial analysis at the end of this chapter. We have a ratio. We have some type of analysis we do at the end of every chapter. In this case, for chapter 2, we learn how to calculate out something called a debt ratio. So we take the total liabilities from the balance sheet and we divide it by the total assets of that same balance sheet. And you're going to get either a percentage or some kind of ratio. So here's some examples for some well-known companies like Costco and Walmart. In the case of Costco, here is their liabilities in millions of dollars, and divided by the assets in millions of dollars. And here's their debt ratio. So the way to read this is for every $1 of assets, the company has borrowed 66 cents of liabilities. Or a company like Walmart, the ratio is a little bit smaller. I just looked at the financials for Apple. Let me see if I can bring that up. Apple has a very high debt ratio. Yeah, Apple is AAPL, yeah, on the stock market. And here is their assets are equal to liabilities plus equity. Here's a liability. This is really in thousands, so you're looking at $300 billion here of liabilities. And here is 352 or $53 billion of assets. Their ratio is more like 0.85 to 1. Look how small this equity is. Again, assets are equal to liabilities plus equity. Why is Apple borrowing so much money? Well, the reason why is because their rate of return on their assets, their profitability they get by owning these assets is much greater than the interest they have to pay on their loan. Okay, so for that type of what they call financial leverage, it's good for the shareholders. There's equity here. If I'm a shareholder and and my investment company can make more money on these assets than the interest they have to pay on these loans, I'm going to tell them, hey, buy more assets, borrow the money. But hopefully your interest rate will stay low and your profitability will stay up. Right now, there may be a coming recession. The Federal Reserve is increasing interest rates. By being highly levered like this, high debt ratio, it's more risky. Yeah, that you can go really the opposite way and have a decrease in your profitability and paying that high interest rate and having excess capacity, excess assets to the detriment of the equity owners here. Okay, so that's debt ratio, liabilities divided by assets. And you also can do a trend going over the years. Looks like it's going down slightly each year for at least these companies. Okay, measuring risk. Yeah, you don't want it to be real low, but then you don't want it to be too high. Okay, so go ahead and make sure you work on your Learn Smart questions, do your homework assignments, and study before you take your chapter quiz. Okay, I'll talk to you later.